Hey everybody, Kevin Shortell here. Thought I'd put together a quick video for you that shows a really good quality note. Now this note, at the time I'm making this video, is not even closed yet. It's pending. So it's very, very new. And I want to point that out because these notes are out there. These are high quality notes. You have to be able to know where to find them, know how to quickly assess the value of those notes, make an offer, and follow through, and then build a relationship. And that's really the key to the whole thing. And that's what I help people with every single day. But let's take a look at this note. This note started as real estate. Remember, the note business is the financial side of the real estate business. So it starts here with real estate. This property was purchased back in December as a part of a bulk buy. So there's companies that raise money. They go out and buy foreclosed properties like this one throughout the United States. This purchase might have included 5 or 10 other properties in different states. It doesn't matter to them because what they focus on is getting them at a deep discount and then selling these properties as is to an investor. They're not taking the time to renovate the properties and sell it to a consumer. They're selling it right to an investor. Let the investor put the work into it. How does the company who's buying these in bulk make their money? Most of it is made on the finance side. Okay, they buy it at a discount. That's important. They then finance it for more money than what they have in it, but that's where they make their money. Now, eventually, the good news for you watching this as an individual note investor is that these bulk buyers who start with real estate, convert it to paper, if you will, eventually want to and need to sell that paper for their investors. That's where you come into play on this one. So from start to finish, this is where it started. REO property purchased by a bulk buyer and then turned around and sold with financing to an investor. Now, they did put that investor through a whole qualification process. But here's what the note looks like. So the investor put a down payment, and then the bulk buyer financed $25,501 for that investor. I know it's an unusual amount, but that's what it is. You can see it right in the contract there. And they created that note at 8.5%. So the real estate investor is happy because they get in with a small down payment. They're only paying 8.5% on their money on a $25,000 note. And as a real estate investor, they're always looking at what's it going to cost me to fix this place up and what's it going to be worth afterwards. And that worked out really well for this investor, which I'll explain in just a minute. So this investor is going to put money down. They're going to sign a promissory note to start making payments on this $25,501 note. That note is secured, by the way, with a security agreement in the form of a mortgage. Now, in the note, which I'm going to point out here and explain later why this is important, in that note, in paragraph 4, you can see that the borrower has a right to prepay. So a payment, you can read right there, a payment of principal only is known as a prepayment. When I make a prepayment, I will tell the note holder in writing that I'm doing so, and I may not designate a payment as a prepayment if I have not made all the monthly payments due under this note. Meaning, if you're behind on a payment, you can't make extra principal payments. But if you're making timely payments, you can go ahead and pay extra principal. And that money, as it's explained in this paragraph, will go towards the extra principal. And that pays down the loan in a much shorter period of time. That's important on this deal. You'll see why later on. Here's the security agreement that I mentioned. So we buy notes, but notes also with a security agreement. This security agreement is a mortgage. So you can see the same borrower there who is agreeing to borrow the $25,501 in the note also is pledging the property as collateral should that person not perform on the loan. In other words, if they have to foreclose on this because the borrower is not paying, the borrower has agreed already that you can do a foreclosure on me if I don't pay you. That's essentially what this mortgage agreement says. There's a reference to the note. You can see that circled in red on the bottom there, but the note is a separate document. So when we buy these, we're buying a secured note. We're buying the note and the security agreement here. By the way, also important, in part 20 of the security agreement, it says the note or partial interest in the note together with this security instrument can be sold one or more times without prior notice to the borrower. And it goes on to talk about the loan servicer may change, etc., etc. The loan servicer will change, but that's a very important part. I was talking with somebody else who's talked with real estate attorneys who had never heard that you could sell a partial interest in a note. Well, it's right in the contracts. And I point this out to people all the time. So it's in there. So this investor, before they got to that point of signing the note and the mortgage, had to go through an application process. And this is where a lot of investors mess up. They try to take the cheap way in creating a note, and they don't take somebody through a formal application process. That devalues the resale value of that note, and it's a mistake. You don't want to do that. This investor did it the right way. So the bulk investor, once again, who found this individual in real estate investor, put that individual through a loan qualification process. They filled out a uniform residential loan application. It's the same application you would have filled out if you were applying to a bank. It shows income and expenses, assets, liabilities, employment. All of that is in that application. Also, they got a transcript notice, a 4506T form, so they could verify the information by looking at the person's federal income taxes. They pulled a credit report, also verifying information that they put on the loan application. And then they agreed that you do have to have escrow for property taxes. They didn't do it for the insurance in this case, by the way. Consumer reporting notices, occupancy affidavit, that they're going to be using it as an investment property, not a property they're going to live in. All of that was disclosed, as well as the property condition. And the property condition in this case, again, here's a screenshot of it. You can see that that bulk buyer who's never seen the property, right? They just bought it as a part of a package. They just put on there, we don't know. We've never been to the property. We haven't sent anybody to the property. You as an individual investor can go out there and look at the property. We're just telling you, you're buying this as is. We don't know the condition. Great. Full disclosure is what that is all about. So the buyer, borrower, also gets what? The deed to the property, right? So there's your three documents. They get the deed. The borrower gets the deed to the property. In this case, they got it through a quitclaim deed. To get that deed, which is the ownership of the property, they had to promise to pay it back, the loan back. That's the note. And the note was secured by a mortgage, and they had to agree to that as well. Great. So now the bulk buyer doesn't own the real estate anymore. They own the paper, the note, and the mortgage. Kenneth here, the individual investor, owns that property. Great. So the bulk buyer kept this note for almost a year. That's what we call seasoning. It's being seasoned. There's a payment history that's accruing on there. The individual investor is paying every single month, and that shows, when they pay on time. Obviously, that's a good thing. If they're not paying on time, it devalues that note a little bit, and if they're not paying at all, it becomes non-performing, which devalues the note even more. Notice I said devalue. I didn't say it wasn't purchasable. We buy non-performing notes, subperforming notes, and everything else. So this note was seasoned. The payment history was coming up on 12 months. And then this bulk buyer who now owns the paper decided to, well, it's time for us to cash out of some paper. So this note in mortgage, along with, again, 5, 10, 15 other ones, was packaged up and sold to a note investment company. So that note investment company purchased this bundle, and then they kept it for several months, and they turned around and listed the individual note for sale for $18,000. That should be $750. I know it says $500. I just saw that. It should be $18,750, by the way. So once again, on that transaction, the bulk buyer bought the real estate. They've got the paper now. They seasoned the paper. They turned around and sold that paper all as a part of a package to a note investor. That note investor kept it for maybe 2-3 months and then listed the property, listed the paper, and sold it for $18,750. They can do that because when you buy in bulk, you're getting a discount price. And then they break them up into individual notes, sell them individually with a markup. Okay, so that's what the note investor did. So you might be thinking, with all of these cuts in there, is there any room for you as an individual note investor to make money? Absolutely, when it's done the right way. So the purchase price of $18,750 versus the value of the property. Now, on Zillow, it said it was worth $62. Other sites said around $50, so somewhere in there. But if we look at the $62,000 value, if you invested the $18,750 to buy this note, it's backed by a property that's worth $62,000. So you're only in it for about 30% of the value of the property. We call that investment to value ratio. So your investment divided by the value of the property, you're in for 30%. So in other words, if you had to take that renovated property back, would you be okay with that? Well, let me put it to you a different way. Would you like to buy a $60,000 house for $18,750? If your answer is yes, you recognize that you don't have any risk in doing this. You have extremely, extremely low risk, even if this note goes bad. Okay, on the flip side of that, the note balance showed around $20,000. I think it was $20,900 that was owed on that loan from the original $25,501. That's not putting you at 90% of the unpaid balance. Now, traditionally, that's getting really high. You know, once you get into the 90s, you're at the peak of the market price here. You're still getting at a discount, but you're in the 90s on that one. In this particular case, that's totally fine if your yield is acceptable, because we know our risk is low, so we can check that box. What about our yield? Well, our yield on this one, on the monthly payment of $276.57, comes out to 11.33. In other words, if you invested $18,750 into a money printing machine and that machine was kicking out $276.57 per month, you would be making 11.33% per year on your investment. So your yield's extremely attractive. Your risk is extremely attractive because it's low. Yes, you're on the higher end of that UPB, but in a case like this, it makes sense. There are big buyers. In fact, there's one that has, over $4 billion in notes, and they will pay upwards of 96% investment to UPB, but not on all notes. On notes that have good credit, and by the way, this person had good credit, A credit, by the way, which is a little unusual, with 30% equity in it in a year's worth of seasoning, they would pay upwards of 96% UPB. So it's not out of the question. And I know there's some investors, you never pay 90%. In cases like this, if you don't do that, you're missing out on some good deals, and you've been mistaught on that. 90% is okay in certain conditions of that, even a little bit higher. All right, here's the thing. In this deal, this person, even though they're only required to pay $276.57 principal and interest per month, there's a small escrow in here, which is $39 a month added to that, but principal and interest $276.57 every month. You can see since this was the first payment here, $425, every other month afterwards, for the most part, they're paying $500 per month. Okay, so they're paying more, which makes sense. If you have a rental property that you can rent for $600 a month and your debt service is $276.57 per month, take that extra rent money, instead of putting that in your pocket, put it towards the loan. Why? Because that's going to shorten that payback period. So this real estate investor is going to pay this loan off much quicker than if they only paid the minimum amount. In fact, if we go in our financial calculator here and put in $500 per month versus the $276 that they're supposed to pay. So remember, your yield at $276 is 11.33. That's what they're supposed to pay, but they've been paying $500. So your yield then would go up, but the time frame on the loan is going to shrink down. So I put that in the calculator here, showing this is what the unpaid balance is this month. And that's the original interest rate. If they're making payments of $500 a month on this remaining balance, they'll pay it off in 49 months. Okay, versus, what was the other number? Over 100 months if we just did the 276. I've got the number somewhere, but over 100 months, they're going to pay it down basically in 50 months. But that also increases an investor's yield to 14.16%. In other words, instead of getting $276 per month, you're getting $500. Now, here's the thing. When you buy this, you want to buy it based upon the $276 payment, because the $500 is over and above. That's voluntary. They can stop that at any point in time. And just because they've done it for a year doesn't mean that they are going to continue to do that. But if they do, great. If they don't, great, because you're still in this deal at 11%. If they make the 500, you're in it for 14%. 14.16%. So either way, you're looking at 11% yield if they go back to regular payments, or 14% if they continue to make the $500 payments. So everybody won in this transaction. The original bulk buyer made their money. The individual real estate investor got really good terms on a note. They're paying it off quicker. There was a company that bought this note in bulk. They turned around and sold it. They made their money. And the individual who's closing on this note this month is still going to make somewhere between 11 and 14% on their money on a very, very safe investment, because they're only in it for about 30% of what the property is worth. That is a great real estate note. Transactions are happening right now. You just, again, have to know where to find them, be able to run through all of the numbers, look through all of the paperwork. You need to act quickly on some of these, and then you want to start to build a relationship with the companies that's creating notes on a regular basis. If you are interested in learning more, send me an email, kevin@kevinshortle.com. That's Kevin at KevinShortle.com, and let's schedule a phone call. I'll send you my Calendly link. We can schedule a phone call, and we'll talk about this and see if this is the right business for you and what I can do to help you in the business as well. So there you go. Hope you enjoyed that case study.